validation, now I validate myself. Building inner strength, putting doubt up on the shelf. No more unnecessary drama, no more wasted time. Climbing higher constantly, making my own climb. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. Whoa. I'm not just living, I'm manifesting my vision. Cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield. I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. I'm not just living, I'm manifesting my vision. Cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield.
How you doing, ladies and gentlemen? Welcome to This and That. I'm your host, Xander, where we're talking about this, that, and everything in between. We got us a pretty straight Tuesday today. February 2025. I want to make sure that you guys like and subscribe. Today, we're going to be following up on yesterday's conversation because yesterday we were talking about quite a few things, but one of the things that we were talking about towards the end, a couple of our guys was asking questions about Myers Industries, which is a plastic developer, and the stocks, bonds, and shares related to stuff to that effect. So today we were supposed to be talking about the perfect time to get yourself in to stocks and grab those undervalued stocks while you still can before those stocks start becoming overrated, overflated. We have a lot of things that I'm going to be looking into in the back end because we're going to be following up on the response for the investigation for the IRS from yesterday. Also, I did confirm that TransUnion, Equifax, and Experience are being sued, in fact, as of January 7th of 2025. So that I got to get some information about that. So you're going to see me talking to you about that coming soon. If in the event that you've got some negative reports on your credit score, there is going to be a way that I will derive to provide to you after confirming it myself through active action that if in the event that you put this information in action, you will be able to find yourself with the ability to remove some of the negative stuff off of your credit report, which gives you the ability to improve your credit score a lot faster. I know a lot of people like to pay off all of their debts and hope to God that they can work down all of the high interest rates and everything to that effect. But a lot of times you just got to charge it to the game. And now there's a way for the stuff that's sitting there to potentially be removed. And I'm going to be working on a way to talk to you guys about how to do that, because as we try to improve ourselves, we improve our finances, we improve our ability to get access to capital. We will be improving on our decision-making skills. We're going to be working on first-person accountability so that we take responsibility for our fallouts when we are in those dire straits situations. We have to recognize that we are the primary reason why we ended up there. So today, we are supposed to be talking about what stocks, bonds, and everything that you can get into that are underrated. Actually, I think we're going to be primarily focusing on the stocks today. But there are other avenues of investments that you can get into. And today, since we're talking about those investments, I want you guys to be able to join me as we dive into certain areas of the stock market. And we're going to find, I've actually found them, and we're going to go over these undervalued stocks that are not only undervalued, but they have high growth potential. And these stocks are going to be skyrocketing coming soon. So let's see if we can spot the next big winner. As you guys follow along with me, make sure that you guys like and subscribe. If you have the opportunity to join a membership, if you like the information I'm providing to you, you can donate something to the podcast, special likes, special thanks, special emojis, gifts, whatever you want to do. In addition to that, if you have any comments or insight, feel free to click the link, approve the mic, approve the camera, and then you can put that information into the comment section, or come on to the screen live and tell me what you got to say about today's topic. We have some debates on here. It's fine. Open-minded, open mic, open forum scenario where we can say what we got to say on here, as long as you keep it reasonably appropriate. I did have to do something about one person that just was completely out of line, but for the most part, we typically like to encourage everybody to speak their piece here. Even if we don't agree, we can hash it out, because here on This and That, where we talk about this, that, and everything in between, the main goal is to make it make sense before we end the show. Now, these undervalued stocks, these stocks are like hidden gems, and these gems are just waiting to be uncovered. And I truly believe that now is the perfect moment to grab them. So the reason is simple. The market is constantly changing, and right now there are some incredible opportunities hiding in plain sight. And we're currently living in a time of great uncertainty, and it is no secret that global economy is facing some significant changes, where global trade tensions, rising interest rates, and geopolitical instability have all contributed to a sense of unease among investors. As a result, many stocks have taken a beating, and their prices have fallen to levels that don't necessarily reflect their true value. In other words, they're undervalued. This situation has created a perfect storm for savvy investors who are willing to do their research and take a closer look. So many businesses are still generating healthy profits, but their stock prices have been dragged down by the broader market sentiment. This disconnect between a company's performance and its stock price is exactly what we're looking for as investors. So the market is constantly overreacting to short-term news, and this has led to some fantastic buying opportunities. But it's essential to stay focused on the underlying fundamentals of a business rather than getting caught up in the emotional roller coaster of market volatility. The stock market currently present is several undervalued stocks that I'm going to be going over today, with potential for significant growth. And this isn't just like way back when kind of situation, because as of February 2025, global markets are approaching all-time highs, with US indices like the NASDAQ composite and S&P 500 nearing their peaks. This environment shaped by inflationary processes and some of the cautionary measures that these monetary policies offers, is going to be giving us opportunities for valued investments so that we can find those underpriced equities. Now, several stocks have been identified as potentially undervalued, and I've got a lot of them. But Provident Financial Services is a trading company at $18.65 a share with an estimated fair value of $36.99, representing a 49.6% discount. Dive in on that one. Array Technologies is a NASDAQ GM price of $6.79. And that's the one that the lower income individuals love. It's the ones that are under $10 with an estimated fair value of $13.53, offering a 49.8% discount. Now, the important part about recognizing these things is that when you're seeing them at such a low rate, that when it bounces back, it's going to double its value. So you're buying it at a little under $7 a share when it's going to bounce back to almost $14 a share after everything starts settling down. So if you put $1,000 on stocks like that, assuming that it does bounce back, that $1,000 turns into $2,000. Now, the Alphabet, which is Google, is listed as one of the Morningstar's top underpriced stock picks for 2025. Needless to say, with the lawsuit that they have going against them, it makes sense that a lot of people backed away from them. But being the monopoly that they are primary shareholders of just about all of their competitors. So they're making profits all over the place, which I never thought about this, but that's a smart move. If you invest in a company and then have that company invest in its competitors, you don't have to compete with your competitors. You can just make profits off of your competitors making profits, which means that you're going to be making money left and right, no matter what happens. And that's probably one of the best ways to go about doing things. But they caught on, and between that and Google utilizing their server as the primary server for cell phones. They have their emails up there as primary users on laptops and computers and everything to that effect, to the point where Google is the only source that people are willing to use, which kind of cuts out everybody else. As a matter of fact, Yahoo used to be one of the very popular browsers before Google came out, and people are treating Yahoo and Bing as if they're viruses. That's how bad Google have taken over the reputation of search engines. So, you have to understand that, yeah, you can throw some money down on Google and receive a large change, a large turnover. But some of these stocks, like I told you before, while they do look attractive, you're not getting capital back off of these stocks and bonds. What's happening is that you put your money there, you leave it there, and when you sell it, that's when your profits come. Now, there's also another thing that occurs, because if you put your money up into these stocks, we talked about this before, that you could, through the appropriate channels, leverage the value of the stocks as collateral towards a cash loan, where you can utilize a cash loan to go and make purchases with, where you can buy items cash up front, and then you can utilize dividends from cash paying stocks to pay off the cash loan, where ultimately you have more money that you owe than what you spent, because the cash loan offsets the cash spent. I would work that route just about any given day of the week. Any interest that you're paying on something like that is the cost of doing business. Now, I told you we got more. Microsoft, they're another top pick by Morningstar, suggesting potential undervalue. And in the basic sectors, the materials sector, so basic materials sector, you have more than 50% of stocks covered by Morningstar, and they are trading with 4 or 5 star ratings, indicating potential undervaluation. Specific examples include Albemarle. Woo! Look, ALB. You got to try to pronounce these things. Albemarle. They're trading at 0.38 times its fair value estimate. Dow priced at 0.55 times its fair value estimate. Energy sector also appears undervalued, with the sector as a whole looking at about 10% undervalued. Notably, some of these picks are Sinclair, HF Sinclair, which is abbreviated as DINO. They're trading at 0.62 times its fair value estimate. Exxon Mobil, the guys that got all that oil in the Gulf and messed up the ducks and caused that really awesome Dawn commercial, they're priced at 0.79 times its fair value estimate. And when searching for undervalued stocks, you have to consider factoring such uh, issues as the price to earnings ratio, which we were talking about yesterday. There's a price to books ratio and a dividend yield, which I find more important than anything else, because you have the amount of money that they just issued in January for the last quarter, the amount that they're projecting to issue in February from January's quarter on monthly dividends, and then you have those that are striking a payment in March for February's capital gains, where they close the books with you on the books, and now you're going to get a dividend payout in the following month. Fact is, if they have an annual percentage yield, which is the amount of money that on average that they're going to be paying out for the year, unless prices go up or go down, if you assume that the percentage is going to stay the same, if they paid out a significant amount in the first payment or the first quarter of the month of the year, you would assume that it would balance back out for the remainder of the year. So you're still looking at, if it does balance out, what's the average? Now, one of the things I've noticed is that outside of some of the outliers that are tough to keep track of, for the most part, most of them are averaging about 12 cents a share, regardless of how much the price is. It's 12 cents a share as dividend distribution. So now the question is, well, how many shares can you afford to buy based on the price of the stock? So these are things that we got to look at if you're looking at getting money back, spendable capital back to cover your investment plan. Now, additionally, you want to look for companies with strong fundamentals, consistent earning growth, and favorable industry conditions. Like I told you guys about going into plastic, because the US government is about to put all of their efforts into contracting into plastic straws. So with plastic straws becoming a thing, you're going to start seeing more plastic materials being utilized. If plastic industries are contracted by the US government, you already understand that most other places in the legal department, like schools as well as courtrooms and law firms and other such, they also shift over to the same plastic, which turns out to be cheaper, and it'll boom that industry for a while until it plateaus, because it's going to be a short boom. It's going to be a short-term boom when it does happen, because the order is going to go out and then all of the materials are going to get used, and then after those materials stop getting used, that's when massive orders are going to start coming out for the plastic, and that's when you're going to start seeing prices for plastic start going up once they start making more purchases for plastic. So probably towards the end of February, beginning of March, when all of the stockpile of plastic materials or paper materials have gone out, if he doesn't just order everybody to throw it out, fact is, come March, you're going to start seeing people doing a lot more purchasing of plastic, and the skyrocket of plastic materials, you should start seeing that development occur between March and April. So if you're paying attention to those stock prices, if they're not already on a massive rise this month, they should be on a massive rise next month. So the value of the stocks should start massively increasing based on those people that are getting a jump on things and buying the shares while the shares are low. But those people who are going to see the trend occurring first before they start getting into it, you people are probably going to dive into it after the fact, riding the wave that already existed instead of getting on it before the wave started, which means you're not going to be at the peak of profits, but you will still be on the ride. But it's important to note that while these stocks appear undervalued based on current analysis, market conditions can change rapidly. And always conduct thorough research and consider consulting with a financial advisor before making any investment decisions. Because while I am not a financial advisor, I am looking at this information, doing my research, doing my due diligence, and then making recommendations to you guys to help you guys make yourselves more successful. Why is his tie so loose? Well, because if it gets any tighter, it's going to be wrapped around my neck. That is a very interesting question to pay attention to when we start talking about thousands of dollars and talking about why is my tie, how loose do you think my tie is supposed to be? Because this is barely a finger length apart. Can you maximize on that? There we go. So, as foolish as you think I am, at least one person has enough common sense to recognize that I know what I'm saying. So, pay attention as I continue on providing you guys with some of this information. So, what are some of the key factors that contribute to undervalued stocks? Well, it is often a combination of things, including market sentiment, economic indicators, and company fundamentals. For example, if a company's stock price has been falling due to a broader industry trend, but its financial performance is still strong, that could be a sign that it's undervalued. Similarly, if a company has price to earn ratios that's lower than its industry average, that could be another indication that its stock is undervalued. Another critical factor is the overall sentiment of the market. If investors are overly pessimistic about a particular sector or industry, like all of the people that are recognizing that we're probably going to be tapped dancing away from paper to plastic, probably are going to start pulling out of paper and putting their money into plastic. So people who are looking at the paper development industry for the paper straws are probably going to start seeing a large dip in the shares. That can drive down stock prices. And even if underlying businesses are still performing well, the stock market does not reflect the profits of the company. It just reflects the value that other people have on the company's stock. So this is where we as investors need to be contrary and look for opportunities that otherwise are overlooked by other people. Now, identifying undervalued stocks requires a combination of quantitative analysis and qualitative assessment. So the valuation market that we're going to get into real quick, because I've got a list of I got all the plastic stocks that I was talking to you guys about yesterday. I'm going to be going over all the values of those today. And then I've got a bunch of the underrated stocks. And you're not going to believe some of the ones that we have. But as I go into them, you have to look at the price to earns. The price to earn ratio is when you have a lower P&E ratio compared to the industry peers, you're going to be looking at specific undervaluations. Your price to books is another way to get it. A low price to books ratio, especially below 1, can suggest undervaluation. So when I was telling you about the other shares that were at 0.3 and 0.5%, that was one of the reasons why they were marked by Morningstar as high value ones to get. Did GME make the list? I'll let you know, because we're going to go through the list. I've got a lot of them up here. We're going to be going through the list. But for those that aren't very knowledgeable about what's going on, I want to make sure that they know before I start going into it, because so you're saying definitely not a value stock. So you're saying GME is definitely not a value stock? Nice. Well, special shout out to Harrison for jumping in and giving us some knowledge. Harrison knows something about GME. You notice, Harrison, that when they try to throw you off by trolling you with random information as if you're going to pounce on it to try to prove your worth, it's very interesting. But I'm glad you were able to jump on that and let him know that GME is not where it's at. He says, Harrison, it could be peep that bounce, but you have to realize that the value of the stock versus the overall performance of the stock is not the same. It can be high this month, but like some of these stocks that have been on a rapid decline for 3 years, it's still lower today, this year, than what it was today 4 years ago. Which, if you are doing a long term investment, that's not a smart move. If it's been on a rapid decline for 3 years, unless some information that you come across gives you the idea that it's going to be on a massive increase going forward, it's not a good move. It's a high number. People look at certain high numbers and say, oh, hey, it's got a big number. Or, like, for example, a $600 share stock that has a 5% dividend payout. You're looking at that like, oh, it's got, good numbers. But if over the year it's operating in a negative, by the end of the year, you'd have lost more money than you made. Is that really a good deal just because the numbers look nice right now? Just because the numbers look big right now? That was one of the things that I was just about to talk to you about. The price to sale, price to book, price to value is basically the amount that the stock is valued at divided by the share. If the distribution of dividends. So if a share is $20 a share and the payout is $5 a share, you're going to divide 20 by 5, and that's your P&E. That's your P&B. That's your PTS. Now, if the number is low, then you got a good stock. If the number is high, then you don't got a good stock. What's low? 5, 6, 3, 2. What's high? 168, 134. Moderate, somewhere in the 30s and 40s, 20s and 10s. Oh, I love this part. And when we're looking at those price of sales, you're looking for useful companies without positive earnings and low price to sell ratios. That's going to also indicate those undervalued ones. Now, I'm going to talk about the EV to EBITDAs. We're going to be talking about those in just a second. But Mr. Mann wants to tell us that it's transitions, because you got transition, become a holding company, not a debt company. Okay, and you're looking at 4.6 billion in cash, and it's interesting. Well, it is good. We should probably look at the difference between a holding company and a stock company going forward. Not today, of course, because I got a lot of stuff to show you guys about the stocks and investments and stuff. Because when you point that out, that is something to think about when a company shifts over to becoming a holding company before when a company used to be a debt or profit generating company. But just because it's holding $4.6 billion worth of assets or $4.6 billion worth of net capital somewhere doesn't change the fact that the gross profits are going to actually be what affects the dividend distribution, and the quantity of shareholders and the quantity of shares that each shareholder has determines how much capital each individual shareholder receives. Now, you yourself can capitalize on how many shares you have, and if you're recognizing the price per share that you're getting in dividend distribution, you can determine if this stock is valuable for you. They have some that are doing biannual distribution, annual distribution, semi-annual distribution, quarterly distribution, monthly distribution, and you have to determine which ones are beneficial to you. A lot of the ones that I'm going to be talking about today have no dividend distribution, where they allegedly focus more on reinvesting the profits into the company for massive growth and R&D development. He says quarter 4 is going to be interesting. I don't own any. I just been tracking it. Hey, look, if you are looking at a stock and you've been following this stock like I've been following Bitcoin since 2015, and you are seeing trends that look promising, whatever chump change that you would have went to the bar club, buy cigarettes, beer, or do anything entertainment wise that would have been frivolous, shallow spending, you should take that money and put it on that stock. If the stock is that good, if you're looking at the numbers and it looks that good, that could be your first investment. Go get it. Don't let it slip. Don't watch a promising thing at a value that you can afford slip away, and then when it becomes outside of your price range, you're wishing that you would have invested in it back when Macintosh was called Apple, where it was just a little box with a floppy disk and we were playing Lemonade Tycoon. You got to understand that back when water bottles were considered insignificant, when somebody was creating water bottles, folks wasn't paying attention to the value of those water bottles. And now everybody has at least one case of water in their house. Some people have a case of water in their house because they live in a country that doesn't have good recyclable water. Some people are bougie and just don't want to drink faucet water because they feel like that's a poor person's drink. Some people don't have the ability to have accessibility to water, so they carry cases of water with them in their car so that they have water in places where they don't have drinkable water. But as you see, I'm talking to you on a show. I go through 2 or 3 bottles of water while I'm on the live podcast. And if they're making 12 cents a bottle off of me drinking water on this podcast, you can only imagine whoever invested on water stock, water bottles, plastic bottle stock, plastic. Thank you, ladies and gentlemen, plastic. Because it's not just the fact that it's a bottle, it's the fact that it's a plastic bottle. And we were just talking about plastic stocks. This is the kind of stuff that we're talking about. If you buy it while nobody's paying attention to it, while the stock is low, when the stock goes up, you'll be just like Warren Buffett when he invested in Coca-Cola. You'll be just like Donald Trump when he invested in the WWE. That's what I'm trying to tell you. Harrison said, GME getting into crypto sounds desperate to me. I don't know. Now, that is a smart understanding to get into. A lot of companies are starting to shift over to cryptocurrency holdings. And one of the reasons why they're doing that is because the US government is about to get into cryptocurrency holdings. But if you pay attention to the executive order that Donald Trump passed, when he passed that executive order about creating the sovereign wealth fund, all the billions of 6,400 tons of gold that's valued at about $30 trillion that we were talking about yesterday on the show, that's in New York right now, that is going to be the catalyst for the United States government becoming a holding company for all of the capital that the United States government is going to be backing cryptocurrency and owning massive shares of TikTok. So becoming a holding company for cryptocurrency isn't necessarily a bad thing. You just have to recognize, though, which cryptocurrencies they're trying to hold, because not all of the cryptocurrencies are going to be successful. We understand that cryptocurrency is going to have the flagship Bitcoin and maybe like Dogecoin or US coin or Ethereum or something to that effect, like some of the top cryptocurrencies that might continue to thrive. But there's a new cryptocurrency coming out every day, every month, every year, and not all of them survive. So you have to look at which ones they are backing. Because if they're backing a cryptocurrency that's not going to be as valuable in the market, then they're going to lose a lot of value in their company. And you investing in them and them investing in Bitcoin is going to cost you to lose a whole lot of money. And Merber says, that's just rumors, ain't going to happen. Yeah, you don't know if it's going to happen or not. Just flipped bullish on GME. It could stay bullish, but it could be temporarily bullish, and that's when people make a massive depreciation of wealth. That's when people take a loss. When you act on emotion and not following trends, and sometimes even when you follow on trends, but when you more so act on emotion, ooh, it's high right now, and you jump in while it's high, and then it plummets. You're not turning a profit after it plummets. You're only turning a profit when the value of it increases beyond the value that you paid for it. So the entire time that it is below the value that you paid for it, you're at a financial loss. So to mitigate that, diversification is what's recommended. Now, EVs to EBITDAs, this ratio is particularly useful for capital intensive industries with low values, potentially signaling undervaluation. Now, your price to earnings to growth is PEG, and this ratio is a ratio below 1, often suggesting the undervaluation relative to growth perspective. Now, your dividend yields is going to be another thing, because a high dividend yield compared to industry's peers may indicate an undervalued stock. Now, another thing we're going to take into consideration is qualitative indicators like insider buying. When company executives purchase shares with their own funds, it can signal undervaluation. Significant price declines. When stocks that have fallen 20% or more from recent highs may present bargain opportunities. And smart money investments is following successful investors like Donald Trump, Warren Buffett, Elon Musk, and that can help identify potentially undervalued stocks. Harrison says famed value investor Warren Buffett made some moves recently. Now, that is what you should be talking about, Mr. Burr, because if Warren Buffett started making some shifts in the market, we should probably start paying attention to what he put his money on. Buffett is investing in what? Beer, pizza, and pools. Well, then why are you not investing in beer, pizza, and pools? Didn't Hulk Hogan just make an all-American beer and aired it live on Raw when Raw debuted on Netflix? Did anybody invest in Hulk Hogan's beer? All of the domestic beers are going to be cheaper than the foreign beers because of the tariffs. If you're not a shareholder in some of the favorite beer and tobacco products that you consume on a weekly basis at the club, you're doing something wrong. Especially tobacco, because aren't they like a multi-billion-dollar industry that continues to grow? He said, dang, I'm going to go full port into Domino's. Well, you need to. Domino's is better than Papa John's. So, I mean, unless you're going all in on Pizza Hut. But we also have to remember that DiGiorno is probably going to outdo Domino's and Pizza Hut, because DiGiorno, you can buy at the grocery store with your food stamp card and bring it back to the house. Drop it in the microwave or the oven. Now, we have some advanced techniques like discounted cash flows, DCFs. This analysis is going to calculate the intrinsic value based on projected future cash flow. You have comparative valuations, where you evaluate a company's valuation relative to its industry's peers, and sum of the parts valuation, where particularly useful for conglomerates that have values where each business segment is separately valued at a reasonably high rate. Now, holistic approaches is going to be effectively identifying undervalued stocks with the combined quantitative analysis and qualitative assessment when you're using valuation metrics for initial screening. Then you want to conduct in-depth financial analysis and industry comparisons. Assess the company's competitive position and growth prospect. And when you're looking at the company's competitive position and growth prospects, you're not just looking at the one company's success rate. You're looking at how successful the company is in comparison to the rest of the companies in the market, or if you're picking the top 3 or 4 companies that are showing the best results in comparison to what you're looking for. That's how you're finding the ones that are the best. And you find 2 or 3 of them that close to one another, you might want to diversify your portfolio and grab a little bit of all 3 of them. That way you'll be able to make it work. And then whichever one that is not as beneficial as you would have hoped, you would have the offset of loss from that one based off of the increases from the other 2. Burr says, I'm going to sell my APP position here soon, so I might slap that into GME. Hey, if you set off on a rocket, you'll be able to jump back into the podcast and tell everybody I told you so. I've been telling them about real estate investment trusts. I'm about to throw a whole bunch down on that this week. I gave somebody a information on 2 or 3 of them that were doing good. Just yesterday, he was talking about moving $100,000, and I'm like, hey, well, I'm about to grab these, and because we had Orchid, we had Two Harbors. That's 2 of them, and there were Two Harbors was looking better than Orchid, but Orchid has the highest percentage rate per year, where Orchid is doing 18.76%, and Two Harbors is doing about 15.1%. But Two Harbors is putting out 45 cents a share at $13.52 a share, where uh, Orchid is $8.77 a share right now, putting out 12 cents a share, where two two shares of Orchid is almost the same amount as 1 share of Two Harbors, where Two Harbors is putting out 45 cents a share for 1 share, and Orchid is putting out 24 cents a share for 2 shares for almost the same amount of money. Where we're looking at, and these, the ones that I was interested in, is because the real estate investment trust are monthly dividend distributions. So if it's putting out this kind of money every month, $3,000 to give you $100 a month, easy. And that's per month, not per year. Like some of these stocks that are annual or semi-annual, or some of the ones that I'm going to tell you later on that are going to be biannual, which means that you're going to get paid every other year on percentages, which is way different. You're looking at exactly how much are you getting out of this. Now, for the startup person, it might make sense to put a lot of effort into high cash paying stocks, as long as you are willing to take that risk, because the more cash back that you get, you can reinvest it into the principal and increase your principal faster, because you only make so much money per paycheck, and you only make so much money per year. You can only invest so much money into the stock. So if you can invest in something that you can reinvest in itself quickly, you can expedite growth in your portfolio, where at some point you can start taking the dividends and start expanding it into other areas, more diversifying your portfolio, taking dividend distributions and putting them into Bitcoin, taking dividend distributions and buying other shares in other profitable cash flow stock options, taking the dividend distributions and using them to pay bills. That way you don't have to pay bills. If you do the smart method, which is what I've been observing, is instead of just taking the dividend distributions and putting them on the bills directly, you go and get you a cash loan that will cover all of the bills, and then take the dividend distribution and put it on the cash loan. And now the cash loan offsets the profits from the dividend distribution, so you're not paying taxes on all that money that you're getting from the stock option, but the bills are getting paid. And you take your paycheck and you put your paycheck on your stock option. Icing on the cake. And if you manage to fondle this stuff around, utilizing an LLC, you can receive some tax deduction somewhere off your C corporation or your LLC, that is in line with any business spendings that you do at the same time, which will save you a little bit more on taxes. Which, if you don't end up not owing anything, you won't owe as much, but you'll be making a significantly larger quantity of capital. Also, each time that you pay off a cash loan in good standings, that puts a better report on your credit score, which allows you to qualify for larger loans, allows you to qualify for larger credit cards, allows you to qualify for better standards to go and get extra funding to do other things. So when you have a lower value credit score, you want to do a lot of secure credit cards, and you want to do a lot of credit builders that have monthly fees, and you want to do a lot of cash working capital loans. But when you have a good payment history, where you're paying back a decent quantity of debt, and you're able to show a large quantity of capital generation, you're able to qualify for unsecured credit cards with no monthly fees. You're able to qualify for low interest rates on high value loans. You're able to qualify better for real estate, where you could buy yourself a house. You're able to do a lot more things. In order for you to get a black card, it's a members only, invite only scenario. You only qualify for a black card if you're spending hundreds of thousands of dollars and paying off hundreds of thousands of dollars, where you're borrowing against a stone hundreds of thousands of dollars and paying off hundreds of thousands of dollars in good time. That's how you end up with a black card. Black cards are credit cards with seemingly no limit to them. You don't get something like that if you don't got a lot of money shuffling around. A lot of people sit here thinking, oh, I'm doing something because they're taking their $3,000 paycheck and rotating it out of a small in credit card. Bro, there was one point in life where I was able to spend $15,000 a week on a credit card and pay the son bitch off because I didn't have enough room on a credit card to use it for anything else. I'd have to pay it off and charge it up again. But you got to make sure that when you're doing this, that your billing cycle ends with a zero balance, and then you start, or like less than 10%, whatever, and then you start maxing that son bitch out. But you never want to go over, because when you start going over, that's when you start getting bad marks on your credit report. Now, evaluate management quality and alignment with shareholders, because that's actually going to determine how often they're going to pay, if they're going to pay, when they're going to pay. Identify potential catalysts for value realizations, which you're looking at the ways that you're going to get paid, because you have two different types of ways you get paid. You get paid from dividend distribution after they stop growing, or you get monthly dividend distribution, or all of the other distribution realizations that I was just explaining to you. And they also have some that I'm going to be talking about later that have different types of payment distribution, where some of the folks get some in the forefront and some of them get some on the back end, and some people get it twice, depending on where they sit in the company. Now, you want to consider the industry's trends and regulatory environments, because that's going to be able to help you figure things out. So, to identify stocks with growth potential, investors can use a combination of quantitative metrics and qualitative factors. Now, these quantitative matrix is going to be the earnings per share growth, where you're looking at companies with consistent increased earnings, your revenue growth, which is going to show strong, consistent revenue growth in a hallmark of growth stocks. Your price to earnings ratio is going to show growth stocks, often higher uh, profits to investments or price to earnings ratios compared to value stocks. When you're looking at growth stocks, your price to sale ratios is going to be useful for evaluating companies without positive earnings. And your return on equity, your ROE, is how people really do business, because they call it return on equity, but you also can identify that as return on investment, the amount of money that you put in versus the amount of money that you get out. A high return on equity can indicate efficient use of shareholders' capital. So, qualitative factors that we're going to be looking at also is market position. You want to seek companies with a competitive edge or unique product service offered. Your industry's trends is going to be identifying the industry's uh, poised for significant growth, such as solar, plastic, crypto. These are going to be the kinds of ones that you're going to want to get into. Real estate, these are going to be the kind of ones that you're going to get to, and such industries like AI and AI technology software. And when you think about AI, you're also going to think about cybersecurity. We just talked about cybersecurity last week. Now, management quality is going to be another thing, like I talked to you about a moment ago, when you evaluate the company's leadership and their track record of meeting goals. This is how companies' leaders getting into scandals in the public can negatively impact the value of a company's stock, because you look at the leadership and their behavior patterns, which aid you in your ability to determine if you're going to invest in that company or keep your money at that company if you already invested. Now, reinvestment strategies is what we were talking about a moment ago, and that's something that we all have to take a look at, because when we're dealing with those real estate investment trusts, you're looking at individuals that can put their money up, and instead of just getting those dividends, you can keep putting money back into the company on a regular basis to keep your principal getting higher. Favorite CEO? That's a good question, Harrison, because I don't really like people, so I don't necessarily have a favorite CEO. I mean, I was always a big fan of Trish Stratus, but you know, she's not the COO. You know, Stephanie McMahon is, but Stephanie McMahon is artificial. So, but would I invest in a WWE? Of course I would. But more so because it's run by Triple H. And it's a multi-billion-dollar industry. And if you put enough money down as a shareholder, then they'll give you perks. Like put your ass on TV for free. Because everybody that's contributing to the company is part of the tour. Now, your growth companies typically reinvest profits rather than pay dividends, and that's going to be something that's going to change people's minds on if they're trying to get money today versus whether they're trying to get money in the future. Don't they combine with MMA on the behind the scenes on the business end? I'm pretty sure that because WWE should have their finger in the rear end of TNA and AWE and all of the other grassroots wrestling industries that cross brand fighters, because you see Eric Bischoff and Hulk Hogan and Kurt Angle coming back to the WWE and doing like guest star segments, even though they are involved and are owned by other companies. So I strongly believe that they're all tied into one another behind the scenes. And just like you've seen the McMahon family in the White House or in Congress arguing about stuff, where Triple H looked like he was about to do his intro behind Linda McMahon. I'm more than sure that as multimillionaires, if not billionaires, that they did invest shares into MMA, UFC, TKO, right? TKO, and other such companies, because and think about this though, because they were smart. Notice that NFL does not compete with wrestling. None of the wrestling shows, none of the wrestling companies air any of their main events on the same day as a Super Bowl. If they're doing it the same weekend, Super Bowl Sunday, wrestling Saturday, that's the closest you'll get, or Super Bowl Sunday, wrestling Tuesday. You're not going to see wrestling Sunday and Super Bowl Sunday because they're not going to make no money. One of them is going to lose fans. But to prevent from being a monopoly, you got 30 days in the month. You can do your main event on Friday. I can do my main event on Wednesday, and they can fly from your main event to my main event, and we both make money. That's how rich people get rich and stay rich and keep rotating out the revenue. So, truth, if you've got capital gains that you're looking at investing in, violent sports is going to be a profit because people love entertainment. People are wasteful. The bottom 99% of the United States population is very wasteful, and they will spend a lot of money on NFL owns Sundays. NASCAR still tries to compete. No. NASCAR is not necessarily trying to compete with NFL, I don't think. I think that NASCAR ain't got no choice but to operate on that day because that's the only day that they can get the cars on the track. Because Sunday is the least amount of traffic on the road. That's my personal observation. I don't think they said, "Oh, nah, we're gonna tackle NFL," because didn't NASCAR happen before or right around football? I got to do some research on that to be sure, because exactly sure. But I know that the first races way back in the early 1900s, the early parts of America, before black people were allowed to play football, like NASCAR and football were not on the same day. But I'm not sure that NASCAR changed its day to compete with football. But I am sure that football arbitrarily changed their days based on the economy. Sunday is the best day to have football, which, horrible to say, they're competing against the church. it's better to put football on Sunday because most people that are not working blue collar jobs are off Friday evening, Friday night football, Saturday afternoon football, Sunday afternoon football, Monday night football. Then they started spreading it out to Wednesday night football. But they moved Monday night football because you got Monday night Raw, and then you had Thursday night SmackDown, and then they moved SmackDown to Friday, and then, and then they had TNA, or no, not TNA, NXT on like Tuesday, and all of this stuff. So they just keep moving around the calendar, but for the most part, like traditionally, you expect the major games to happen on Sunday evening, which is why you typically see like all the pay-per-views for the WWE happen on Saturdays. Notice that? You never see like, oh, this Sunday and on Raw. No. You don't see like Elimination Chamber Sunday night. No, the Elimination Chamber happens on Saturday night. And football happens on Sunday night. That's what goes down. And NASCAR just happens while the sun is out. So we also have to look at expansion potential. Now, bear with me now because I'm going to get through this because we got a few more things I want to teach you guys, and then we're going to start talking about the rest of these talks. I think I got like 25 or 30 of them that I want to tell you guys about. So anybody who's interested in getting the inside track on all the undervalued stocks that I've found over the past 48 hours, that is effective the 18th at 4:59 p.m. Eastern Standard Time. This is the value of these stocks that I'm going to be giving you guys today. So hang out with me as I go through a lot of this information, because if you didn't know what's going on, you're going to learn it from me today. And then after we talk about this today, we're just going to just dive right into whatever stocks we should be paying attention to. And anybody who wants to know, how did I know that? I'm going to tell them, like I told y'all yesterday, go watch a previous show because I already took the time to explain it at least once in my life. So expansion potential, stocks are going to be ones you're going to be looking for companies entering new markets. Just like when he was talking about, when Murr was talking about that company, GME, potentially shifting into a holding company. You're looking at when they're entering into a new market or customer segment. That's going to be important to pay attention to. So he might have something there, but it might be a flop. It's a 60-40 chance. You never know. When you're using advanced techniques, when you're looking at the discounted cash flow of those, you're going to be calculating the intrinsic value based on the projected future cash flow of that particular transition. The relative value of cash flow from the assets of the value of growth relative to the marginal improvement that you're expecting to see. You're looking at compound annual growth rates, where you're comparing the growth rates between companies more directly. Now, when screening growth for stocks, you want to consider using tools like Stock Screener to filter for high EPS growth, revenue growth, and non-dividend paying stocks. And additionally, benchmark a company's performance against relevant indices like the Russell 1000 or Russell 3000 to gauge relative growth. So remember that while growth stocks can offer significant returns, they also carry higher risks due to the market volatility, and it's crucial to conduct thorough research and consider that you diversify your approach whenever possible while you're investing in growth stocks, because again, you're buying a seemingly undervalued stock with the potential to grow, and if something changes in the market where that stock doesn't grow, you don't have that increase of revenue that you were expecting. And to offset the perceived loss of not growing, you want to have investments in other stocks that does grow so that your portfolio still increases to some magnitude. Now let's take a closer look at a few examples of those undervalued stocks that could be great investment opportunities right now. So one company that caught my eye is XYZ Inc. and leaders in the tech industry that people aren't paying attention to because it's not SolarX, but XYZ Incorporated. Despite its strong financial performance, the stock has fallen by over 20% in the past year due to broader market concerns. However, with its solid balance sheet and a proven track record of innovation, I believe this company has huge potentials for growth. Another example is ABC Corp, a retailer that's been unfairly punished by the market due to concerns about the rise of e-commerce. While a lot of people have no faith, we were just talking about a moment ago in cryptocurrencies and digital transactions, digital spending, and digital investments is starting to become a rage. It's going to be the Gen Zs are going to be tackling this particular type of market. So we have to start paying attention to the next generation's investment strategy because that's going to impact the valuation of our profit margin as those Gen Xers that are like, yeah, I ain't even trying to have it. So while it's true that the retail landscape is changing, ABC Corp has been investing heavily in its online presence and has a solid plan to place a stay ahead of the competition. Now, with its stock trading at a price to earnings ratio of just 10, I believe it's a steal at a current price, at this current price. But now, look, we have Merck and Co., the NYSE MRK. It's a leader in pharmaceuticals with a strong oncology portfolio and potential for expansion in new therapeutic areas. So we're all over the place. Well, I'm about to start talking because plastic is going to be the last thing I talk about. We're all over the place right now. This is pharmaceuticals. It has $83.29 a share with 81 cents per share quarterly, with an annual $3.24 dividend distribution. Uber Technologies, I just told y'all yesterday that if y'all put y'all money where y'all put y'all stock options where y'all put y'all money at, you catching an Uber all the dang time, you should be able to invest in Uber stock. Now, Uber Technologies, NYCS UBER, dominating the rideshare market with expansions into delivery services and autonomous vehicle technology, because guess who made the robo taxi? Elon Musk, supposed to debut Q1 of 2026, $30,000 driverless car. So if you partner with Uber and buy 20 of those robo cars and put 10 of them on a road every 8 hours, you can rotate out cars, maintain maximum charge, not be on the road, and spend more time on your cell phone redirecting traffic, where your account would be generating significant revenue shares. Well, not just shares, it'd be just significant revenue. And since electric cars have less mechanical parts to maintenance, you would be doing more tire changes and depending on the mileage on the batteries, swapping out batteries at $5,000 to $10,000 a battery, but you should be swapping those batteries out at 200,000 to 300,000 miles per electric car. And at 100 miles a day on average, 100 to 150 miles a day on average, on a 300-mile per charge car, you're probably going to be able to put a few 100,000. Well, yeah, probably a few thousand days. And you put a few thousand days, that'd be a few years before you have to change out that car. But if you're drawing back like $200, $300 per day, $400 per day per car, the total profits from each one of those cars could potentially give you enough money to buy batteries as they change out. And that's why I told you buy 20 of them and put 10 of them on the road at a time. Because if you buy 20 of them and put 10 of them on the road at a time, you not only don't have to use the maximum quantity of charge time, you also have the ability to rotate out the ones that are low on charge so that none of them ever run out of charge. And you have the capability to take some off the road for repair while maintaining the maximum production rate of 10 cars at a time, which in case of an accident, you have the ability to remove a car and still have your 10 cars. And now you have 9 cars at the shop and 1 car totaled out and still be able to maintain your 10 cars at a time. But at $30,000 a car, if each car is going to make you more than $30,000 a year, you're turning over a massive profit. At $30,000 a car, if you're going to keep the car for 10 or 20 years, where you're now paying $3,000 a car for the value of the car, but the car is turning over $30,000 a year of revenue per car, you're still making a massive profit because you get 100% tax deduction the first year. So how you think you will pull that off? You buy 2 cars for 60 grand, you put them to work, rotate them out, take the profits, buy a 3rd or 4th car, put them to work, and before you break even, you buy 2 more cars and you just keep expanding on your operation, where you pocket 40% and you use the other 60% for expansion on the industry. Likewise, depending on the market, you could potentially partner with Uber as a rideshare company, subcontracted through Uber, where you could put all your cars to work. You just got to work that out with the company. Now, they have share prices of $81.41 for Uber. Now, Uber currently does not give dividend distributions. But again, if the values of the shares is increasing, you have the capabilities of using your revenue from, or not revenue, but the value of your Uber stock, excuse me, to leverage for cash loans to buy more cars. Also, you can use working capital loans on top of that to buy more cars and invest in more stock, all the way around. Now, Constellation Brands, it's NYSE STZ. That's for Constellation Brands, a major player in the beer market. Now, we just finished talking about Hulk Hogan, but now we're in the beer market with potential for growth in premium products and international markets. These guys have a share price of $169.38 a share. Their dividend shares are $1.01 per share, and that's going to be a quarterly dividend distribution, where their ex-dividend share date was February 7th, which was about 11 days ago, and that payment date is going to be February 21st, which is in like 3 days. Alphabet, also Google, that's NASDAQ's Google. They're a leading in AI integration and digital advertisement with strong potential in cloud services. Their share price is $185.77.5, or if you round that up, 78 cents, where dividends pay a quarterly 20 cents a share, a total of 80 cents per share annually. Their dividend yield is 0.43%, and the dividend payout rate is 9.94% based on trailing earnings. So their next dividend payout date is supposed to be March 17th of 2025, and the next ex-dividend date is supposed to be March 10th. So you've got until March 8th, unless March 8th is a weekend date, you might have March 7th. If you get your money in and on the books before the ex-dividend date, then on the 17th, you get paid for the whole last month. If you miss the ex-dividend date, you will get compensated on the following payout. Now, L. Lilly, which is NYSE's LLY, is experiencing success with GLP-1 drugs, again, pharmaceuticals, and this has a promising pipeline for future growth. So their share price is high, $857.02, and they have dividend yields of 0.69%, where the dividend distribution was $1.50 per share quarterly. So that's once every 3 months. Well, no, yeah, once every 3 months, with an annual dividend of $6 per share. Their last dividend of $1.50 per share, ex-dividend date, was February 14th, which was about 4 days ago, and that is going to be payable on March 10th of 2025. So their dividend growth for 1 year has been 15.14%. So you want to pay attention to that stock as well. Cisco Systems is NASDAQ's CSCO, expanding into cloud computing, AI, and hybrid work technologies. Their share price is $64.59. Their dividends are 41 cents per share quarterly, with $1.64 annually. Qualcomm, the people who made Qualcomm Talk, the Snapdragon in software on a chip, you know, these guys make all kinds of processors and enhancing speed of computer technology. They are a leader in 5G technology with strong positions in the semiconductor industry, who, might I want to point out, doing a good job working with T-Mobile right now with T-Mobile's 5G services, where the share price is $173.64 with dividends of 85 cents per share quarterly, with $3.40 annually. Toyota has NYSE's TM, Toyota Motors, investing heavily in electric vehicles. A little late after Elon Musk, but they're investing in electric vehicles and autonomous driving technology, keeping up with the Joneses. Their share price is $184.07 as of February 18th, with current dividend yields of 2.96% and dividend payouts of $2.86 per share semi-annually, where their last dividend of $2.60 per share was ex-dividend date of September 30th of 2024, and the payment date was December 6th of 2024. Next dividend date with $2.86 per share is expected to be March 27th, where their estimated payment is June 3rd. And for those of you who weren't there for quarter one's distribution, you kind of missed the ex-dividend date and the payout. So your next one is gonna cut in March and pay out in June. Now, Intel, which NASDAQ's INTC, is focusing on AI, autonomous vehicles, and quantum computing for future growth. Their share prices are $27.37 dividend payout, with 12.5 cents per share, with a quarterly, that's a quarterly share. Annual share is supposed to be 50 cents annually, where their dividend yield is 2.7%. Now, their next ex-dividend date is estimated to be March of 2025, and the next payment is going to be June because they're doing quarterly. Intel's dividend has decreased from previous years, and that's why I tell you guys, don't get too excited over when things are doing good, because Intel went from $1.46 a share in 2022 to 74 cents a share in 2023, down to 50 cents a share in 2024. Now, analysts expect a slight increase in dividends to 52 cents per share in 2025 fiscal year, representing a 1.653% increase. But it's not doing as good as it was doing 3 years ago. So if you're looking at trends, it's kind of on a downward, but it's expected to start going back up based on the way things are going right now. Amazon, in spite the union that just occurred, Amazon is listed as a top value stock to buy and hold for 2025. Their share price right now is $226.65 as of February 18, 2025. They are still not paying any dividends at this time, so you're not going to get any money back off of this on a monthly, weekly, quarterly basis. But again, you can maximize that depending on how you leverage your assets. Now, it's important to note that stock prices can fluctuate rapidly, and the provided prices are as of 4:59 today, Eastern Standard Time. And you have to remember, additionally, dividends information may change over time, and companies may adjust their dividend policies. So yesterday, you guys, there was a question that came out about what plastic stocks we should invest in. Myers Industry was the first one mentioned. And as of February 18, 2025, Myers Industry stock, MYE, is trading at approximately $12.06 per share. The company has a dividend yield of 4.39% at 52.9 cents per share. Now, Myers Industry is a manufacturer of those sustainable plastics that we've been talking about, while I'm sitting over here on my second bottle of plastic. They also work with metal products for various markets, including industrial, agriculture, automotive, commercial, and marines. The company has a 90-year history. So remember, I told you guys to focus on the longevity of the company. This company has approximately 2,500 employees. And in 2023, Myers Industry reported a net sales of $813 million and a net income of $49 million. The company has 3 horizon growth strategies aiming to reach $3 billion plus in revenue by 2029, to go from 813 million to 3 billion in the next 4 years. Myers Industry recently acquired Signature Systems, a supplier of composite ground protection and turf protection solutions, to support its growth strategy. Now, other plastic stocks that I told you guys that I was going to tell you about, if you weren't ready, you better get your pen and pencil out, because we're about to start talking about some pretty shifty stocks real quick. Now, Eatergrass Incorporated, ENTG, Eatergrass Incorporated shares price is $100.99 a share, at 9.27% increase in the last 30 days. Berry Global Group Incorporated, BERY, has a share price of $69.04. AZEK Company Incorporated, AZEK, has a share price of $51.26. Armstrong World Industries, AWI, has a share price of $151.13. Newbell Brands Incorporated, NWL, has a share price of $10.76. Lloydell Basel Industry, LYB, has previous close price of $76.42 with a markup cap of $25.19 billion. Their P/E ratio is 11.8, which is undervalued. Westlake Chemical Corporation, WALK, WLK, has previous closing price of $112.52 with a market cap of $14.52 billion. And their P/E ratio was 156.89. That is overvalued. That is going to be somebody that's going to be more focused on investing for future growth. You can jump into it if you want to, but you're not looking for an immediate satisfaction. Now, Dow, DOW, is share price of $39.72 as of February 18, 2025 at 4:59 p.m. Eastern Standard Time, with dividend payouts of 70 cents per share quarterly, with annual dividends of $2.80 per share. The next dividend payout is going to be March 14th, with ex-dividend date of February 28th, which is about 10 days from now. So if you want this stock, you got to get in there within the next 7 days, minus weekends. So you might have to do it like 6 days. Supreme Industries has a share price of $44.02 with a P/E ratio of $45.22, which is about average, and dividend payout of 12 cents per share, and your dividend yield is 0.77%. Dividend frequency of this company's payouts is both interim and final dividends. Your Astral share price is $16.37, with dividend payouts of the latest interim dividends of 0.018 per share annual dividend and 0.045 per share dividend yield at 28 or 0.28%, with the P&E ratio of 71.71, which is also a little bit higher than average. Now, the dividend frequency is biannual, and they're paid in September and December. There are many more examples out there, and I encourage you guys to do your own research to find the hidden gems that resonate with you. Now, remember, investing in undervalued stocks requires patience and a willingness to go against the crowd, but the potential reward can be huge. Now, is the perfect moment to grab undervalued stocks today, or are you guys going to wait until next week? Because me, I'm going to be trying to dive into it right now. These undervalued stocks could skyrocket in value, and the market is always changing. But by focusing on the underlying fundamentals of a business and being willing to take a contrary view, we can find incredible investment opportunities that others are overlooking. Definitely make sure that you guys like and subscribe. Take the time to join a membership and put a lot of extra effort into tagging us for tomorrow's show, because I do believe tomorrow we're going to be talking about the best parts in Nepal, investing, and putting a little bit of side money into what we're going to be doing into Nepal with our stock option investments tomorrow. Definitely make sure that you guys, if you know about some undervalued stocks, just like a special shout out to Harrison and Mr. Burr, if you guys know about any undervalued stocks that I didn't mention today, make sure that you throw them in the comments down below. If you're new here, make sure that you put your effort into liking and subscribing. Special shout out to Red Void, Omni81, Mr. Pibbs, and Liberty Twitcher. Special shout out to Twitch and Twitter. If you guys are looking for more content on investment strategies and stock market insight, and if you want to learn more about the top investment strategies, you want to make sure that you check out a lot of the videos on dividend investing, and make sure that you check out some of the links that we have in the description down below. Now, remember, as you come to the show, you're going to notice that we are live 7 nights a week. We put in a lot of effort in making sure that we do extensive research before every show. So you are getting in the moment, up to date information on right now in the moment topics, which is hard to do. However, I'm making it make sense for you, and I'm making it work. Either way, you want to stay tuned 7 nights a week. We typically start a little after 10:30 every night, Central Standard Time, which is a little after 11:30 Eastern Standard Time, which is a little after about 7:30 California time. If you are on the eastern side of the world, Green Minutes time, it is about 4:30 a.m. Universal Standard Time, it's about 4:30 a.m. that we are going to be here. If you're in Asia, Brazil, Romania, Nepal, Indonesia, Asia, anywhere in Asia, Russia, North Korea, you're going to see us at about 4:30 a.m. You can tell, you can look at your clock right now. It's probably like 7, 8 o'clock in the morning for you right now. For me, it's like midnight Central Standard Time. So you can understand that we're going to make sure that we rock this boat for you. So if you're waking up 4 a.m. and you're coming to the podcast and you're going to have your breakfast, drink your coffee, and listen to business and finance, stocks, and social improvements, make sure that you make this a habit, because as we make it make sense for us, I'm going to make it make sense for you. And as we take advantage of these financial opportunities, as the market is changing, as the world is changing, over the next 4 years, some of us should make it to millionaires. I should be one of them. And if you're following me, you should be one of them too. So I appreciate you guys coming to tonight's show. I want to make sure that, ladies, on my way out of the door, I tell you guys on a regular basis, as long as the situation doesn't make sense, I'm going to keep asking you ladies to make it make sense. So ladies, please make it make sense. Fellas, I appreciate you guys continuing to come to the show. We're looking at riding on still about 69% followership from the fellas. So keep it strong, guys. We got to keep showing that love, keep showing that potential. I really appreciate you guys coming to the show. Make sure that you guys stay tuned for Higher Ground outro as we roll out of the show, because alanito music from Switzerland, live band, made the songs exclusively for this and that. We have their information in the description for the songs where you can go and listen to the songs on YouTube or purchase the songs off of Amazon Prime. So I strongly encourage for you guys to take a listen to Higher Ground, which is the show's official music. And if you guys got any comments that you'd like to throw into the podcast, special shout outs to friends and family, special shout outs to your country, that wherever you are, rep where you're from. During the outro, I'll make sure that I throw it up on the show as we wrap things up. Thank you guys for coming to This and That. I'm your host, Xander, where we talk about this, that, and everything in between. And I'm going to see you guys tomorrow night at around about 10:30 Central Standard Time. Thank you guys, and have a
Higher ground. Used to chase validation, now I validate myself. Building inner strength, putting doubt upon the shelf. No more unnecessary drama, no more wasted time. Climbing higher, constantly making my own climb. Standing on higher ground where excellence is found. My potential knows no bounds, raising the bar, breaking ground. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command. I'm not landing on higher ground where excellence is found. My potential knows no bounds, raising the bar, breaking ground. I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never yield.